Hi, welcome to the Economic Circle. This is Dr. Alex Moseley, the founder. In this lesson, we're going to review the economic principles of the origins of money and particularly problems that emerge with banking. And this is part 2 of the banking issue. First of all, let's have a quick review. The principles of money. Money is not invented. It evolves through market activity driven by traders who are keen to reduce transaction costs. Banking is a service that emerges on the market to reduce trading costs by offering the clients deposit and security services such as well as monetary substitutes that help to facilitate transactions, such as check-in, internet banking, direct debits, point of sale, debit cards, etc. today. However, when bankers begin to use or to monetize money held on deposit for their own investment purposes, they begin to breach clients' trust and contracts. So if there's money sitting there on deposit for withdrawals, but the bankers say, hey, why don't we use that for our own investment purposes? This is when there's a breach of contract going on. Now, so long as the banks do not issue more money substitutes than the hard money deposits they have on reserve, now traditionally hard money is gold and silver on the markets, banks who surreptitiously use their customers' deposits are redistributing funds away from clients, away from the marketplace to themselves. They make a profit on their clandestine activities, but they're also just liable to err and also lose depositors' funds. Now, what is the second problem? That's what we looked at before. Using other people's property for personal gain has generally been struck down in the courts of law through history and across societies. In a deposit contract, it is assumed that ownership and use of the monies, or jewels that happen to be in a safe, are not transferred to the banker, and that the client has rights of access over her property. Makes sense, because that's why you put your money in the bank, yeah? Now, something more nefarious occurs when banks expand the quantity of money substitutes over and above the quantity of hard money that they have on account. Let's read that again. So banks are expanding the money substitutes, pieces of paper, token coins, etc. We're going to be looking at paper money in itself in another lesson, but it's also subsumed in this tutorial that banks are releasing substitutes over and above the reserves they've got on account. Issuing fraudulent claims. Now, even in the very early days of banking, bankers noted that not everybody would come and claim their deposits at the same time. Now, companies of all sorts sometimes commit accounting fraud by exaggerating their stock levels to gain further investment advances. This is called cooking the books, in other words, accounting fraud. For instance, a car factory may claim that it has a stock of 1,000 cars for sale when it's only got 800. This may attract investors or be used for some other purposes, but ultimately, you cannot cheat reality. 1,000 is not the same as 800, no matter how much German philosophy you've studied. An audit will uncover the fraud, or if the dealership attempts to sell 1,000 cars online, say, there will be 200 very angry customers who turn to pick up their car and find they've been cheated. Now, people who cheat don't get far in the marketplace. The reputation of trustworthiness is hard-earned and easily lost. States that cheat just change the laws in their favour, but we're going with the marketplace at the moment. So if you try and cheat people in the marketplace, sooner or later, you're out of integrity. The market, the universe catches up with you, however you look at it. These are the rules of life. Now, bankers who issue their own notes and cheques for circulation in the market always face the little temptation to issue more notes than deposits held. So long as the note holders don't all turn up at the same time, the banks can get away with the fraud in just the same way as the car dealership can until it is audited or the clients turn up expecting to take ownership of the imaginary cars. Makes sense. And similar to the dealership, the banks can use their scam to attract more funds or investors. So, imagine that the bank has £1 million on deposit. This bobbles up and down as clients pay in money, make their withdrawals, payees make claims on the deposits through the interbank clearing systems, etc. Right? Now, noting that only about 10% of the funds are typically withdrawn from its clients' deposits in any given month, the bankers realise that they can get away with issuing a few more notes through some loans and overdraft facilities. Assume that the bank issues money substitutes like this for its clients, who then circulate these in the marketplace, and these constitute about 200,000 on average each month. Tentatively, the bank issues another £100,000 to businesses keen to borrow funds. Oh, But it's not raised any monies from investors. It has not raised this 100,000. Instead, it is presumed that it can lend these out. And again, the deposit banker is now taking on the mantle of the investment banker without having earned the commercial right to act as a lender. It has not attracted any funds from investors. It's not increased its hardcore cash. It has merely, that should say, created the substitutes out of thin air and then lent them out. This is where the credit pyramids form. Sorry, I love these pictures on Keynote, and I've just upside down them to show that basically banks begin to expand the credit from the base upward. I think it's lovely, right? Now what's happening? The banker begins to circulate more substitutes than reserves. He may lend these out for a charge even, interest to be paid in hardcore cash, every month, of course, or create an overdraft facility which allows the account holder, imagine you're a student, to draw on funds available in the bank's deposits and pay the bank for the privilege. Should the holder withdraw cash on the facility, the bank will print more notes accordingly or do electronic transactions today. Again, let's emphasise this. The banker has not attracted any funds to his commercial, i.e. fraudulent cause, but has merely created, at a very low cost to himself, extra substitutes that enter the marketplace, that which the banker will then charge for and then push up prices in the marketplace, because these issuances are acting as money. The overdraft facility is used. Money substitutes are pulled out the cash in the wall machine. Freudian slip there. They then circulate. This pushes prices up. This is called having an inflationary effect. Let's have a look at the bank's assets at the moment. So you've got some hardcore cash acting as the base pyramid, and then tentatively there's a credit issuance into the market, loans to businessmen, to students, for example, to householders to buy, get a mortgage or something. Now, the tentative expansion of monetary substitutes, such as redeemable notes, token coins, or electronic deposits, has the same effects as the discovery of new gold veins or silver deposits. In other words, more money enters the economic system, the markets, pushes up prices. Bear that in mind when governments take over this, get carried away and print loads of money. Right, can the market banker get away with it? So assuming a market system at the moment, can the banker actually get away with what they're doing here? Well, cheaters never prosper is an old saying. So imagine one bank issuing funds and earning hardcore gold and silver in return from all the students and business people that it's lent it to. Now this is incredibly lucrative for the bank, as the costs of issuing these substitutes are low and the borrowers are paying the bank back with real hardcore cash. This bank's profits will rise. This in itself will start to attract attention from competing banks who might be wondering, how the heck are they getting their business, dear boy? Yeah, I don't know. Let's go find out. Now at this point, other banks may grasp the technique. Here's a rather spiffing idea. Why don't we print a few money substitutes, lend out some extra money that we don't have, and charge real hardcore cash? Splendid! An action this will only work if all banks collude and they do not breach their collusion. On the other hand, they may just decide to create a run on the bank that's printing money and really see how solid its reserves are. We come back to bank runs later. Or traders, depositors or investors may get wind of the cheat and demand full repayment in specie, i.e. gold or silver or whatever hardcore cash is, for any of the substitute coins, notes or electronic deposits that they hold. And herein lies the rub, as Shakespeare says. A bank run. If a bank is maintaining 100% reserves on all of its substitutes, testing its ability to redeem notes will not pose a problem, because it will handle it. But like the car dealer who pretends to have 1,000 cars but only has 800, a banker who issues extra notes increases its assets with nothing, nout if you're from the north of England, behind them. By issuing 100,000 into the marketplace through loans, etc., and therefore pretending to have assets of 1.1 million, not 1 million, fraud has been committed. There's a violation of reality here. Now, should traders test the bank's resilience, it will struggle to redeem the substitutes. Word quickly gets out that the bankers are up to no good, and this starts a bank run, as deposits scramble to get a hold of the monies owned to them by the bank, because after all, they've deposited their money. They've not said, here's our money, print as much of it on top of it as you would like, and charge other people interest and we'll take a return. No, they've deposited money in the bank on a deposit for withdrawal purposes. That's it. So quite a few frauds going on here. What if all the banks do it? Well, same problem, but the consequences can be more devastating. So if the banks start to collude in this, what a spiffing idea, we should all try it. When depositors get wind that the banks as a whole are not holding all the reserves that they appear to have according to the quantities of substitutes released, all banks can then be subject to a run of domino effects, clunk, 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 causing panic and mayhem as the bankers scramble to pull in loans that they've made, and they want hard cash to pay off the depositors who are scrambling over the counter to grab all the money. But remember, the deposit bankers are not investment brokers. Their contract was and is to maintain depositors' funds securely, permitting them to withdraw and add to their accounts as they see fit. They were not, underlined 3 times, in a position to use those funds for personal or corporate gain, nor do they have any moral right to create assets out of thin air. As one American judge said, only God can do that, with an American accent. Sorry. Insofar as the banks act together in expanding credit, money substitutes, they are effecting, creating an inflationism, which is a policy of devaluing the value of the hardcore money, or the money supply that's in the marketplace. When the credit pyramids that they have created collapse, there is a systemic or systematic deflation of prices. In other words, trouble in the economy. The issuance of these irredeemable notes, these artificial notes, also affects interest rates, and hence can also distort investment markets. Now, when you're studying monetary economics and economics, what you find out is that this is called monetary policy, and it's very splendid and spiffing. No, it isn't. A lot of it's based on a scam, actually, which is quite fun. Anyway, the best lead schemes of mice and men, in this case the fraudulent schemes. So long as the bankers do not have legal protection, what do you mean by that? Now, which historically the banks have sought and eventually won off governments, the markets, in the shape of investors, depositors, accountants, auditors, etc., etc., will eventually catch on to the scam. But rewind. So long as the bankers do not have legal protection, do you mean to say, Dr. Moseley, that they do have legal protection? Yes, I do. That's what the modern banking system is all about, which we'll get to in another lesson. But if it were just solely in the marketplace, if people were cheating in the marketplace, like pretending they have 1,000 cars and they've only got 800, pretending they've got 1.1 million in the bank and they've only got 1 million, there's a problem. Now, if the local markets don't catch on to the rising bank profits and their lack of reserves behind them, foreign traders would soon do so. Now, the locally denominated notes or money substitutes would gradually but surely be discounted in the currency markets for the risk of insolvency that they bear. Interesting. Do you think this happens every day on the currency exchanges? Of course. Which side of morality, then? There are economists who defend what is known as the fractional reserve banking. In fact, when I was a student in monetary economics at both the undergrad and the master's level, my hand would immediately go up and say this is one huge pyramid scheme and it's a bit of a scam. Oh, don't worry about that, don't worry about that. It won't be on the exam, don't worry about such things, just pass your exam. Right. Now, either this is because the economists have not studied or thought about the violation of trust and reality it entails, or because they themselves are on the profiting side of the equation, i.e., they work for the dark side. When a bank issues credit beyond its reserves, the bank profits greatly, and so too does the borrower. Both can now attract more resources with the credit than other players, players in the market. They become richer, but they do so at the expense of those who experience price rises. There will be more on this in another instalment on the origins of money and the problems with banking from the Economic Circle. Thanks for listening, guys. This is very much fun, and if you get your head around this, you'll start to understand why we have huge monetary problems every now and again, such as hyperinflations and business cycles, etc., etc., as well as credit crunches 2008. You'll understand where that comes from. Also, don't forget we're available on Apple Newsstand, the Economic Circle magazine. It's pretty cool. Last one, April 2015, on privatisation of roads, was absolutely free. Otherwise, there's a small subscription fee to help fund all the research, etc., etc., and the funding of the magazines. And we're also on Google Play. Thanks for listening, and see you in the next instalment. Cheers. Bye now.